Hello, investors. I'm Destiny Fernandez, the marketing manager at Catalyst Funding. We want to thank you for joining our call today and keeping an eye on the ever-changing market with us. Before we dive in, I want to remind you this webinar is being recorded and you will be sent a copy tomorrow via email. If you have any questions for our speakers, please write them in the question box and we will answer them at the end. And don't forget, one lucky winner today will receive half off their hard money processing fee with Catalyst Funding. You must be live on the call to win, and we will announce that then. As always, we love providing this monthly webinar as a tool to assist you in assessing the current and future market. However, we do want to note that Catalyst and our associates and/or guests are not liable for any investment decisions you make hereafter. Please always conduct your own due diligence before moving forward with a deal, or feel free to contact us. We do have fully licensed loan officers that are trusted advisors here, and they're happy to walk you through deal-specific questions. Without further ado, I think we should go ahead and introduce our guest speaker, but actually, I think our CEO would like that honor today. Wade, you want to take it away?
Sure. Yeah, I'm going to let, of course, Marco talk a little bit about what his team does and his background. I just want to personally say I've been listening to his podcast for years now, provides excellent information, so I'm super excited to have him on the podcast. I'm sorry, just a joke, on the webinar today. And he's going to provide a very interesting perspective from a nationwide evaluation. You know, we often focus a little bit more on Texas. We're flipping that around today. We're really going to focus on like a mid-year evaluation, talk about the second half of the year. Marco's background is going to bring a tremendous amount of great information to us, and his forecast for the second half of the year are pretty exciting as well. Marco, tell us a little bit about what you've done and your podcast and anything else you want to cover.
Sure, I appreciate that, Wade and Jeff. Just real brief, I mean, it's on the slide there, but you know, I started investing in real estate when I turned 18 years old, and I had to literally wait until I was 18 years old because I couldn't qualify for mortgage financing prior to that. But you know, I just wanted to get in real estate early on. I've been a serial entrepreneur my entire life, and one of the things I love the most is real estate because it's just it's the most historically proven asset class. It's a great way to preserve wealth. It's a great way to generate wealth. It is great in terms of meeting or beating the real rate of inflation, which is something we can touch on today. And when you build a portfolio, it generates income. So, you know, my background is predominantly real estate, but just to add a little bit more color, I run multiple businesses, including a fund, and I have invested in everything from cannabis to crypto. I'm co-producing 6 Broadway musicals. I'm just all over the place. So I love what I do, and it's fun helping other people and teaching them and showing them the way.
Can you sing for us too, Marco?
I was gonna say, we've had a lot of real estate investors on here before, but we've never had Broadway producers. So yeah. How'd you get into that?
Oh, that's a whole long story, but I actually, through one of my mastermind groups, I actually met one, Andrew Lloyd Webber's right-hand man. It's basically the executive director for North America, and we got talking, and he said, I love what you do in real estate. I need to invest. Where have you been for the last 5 years? And then I looked at him and said, I love what you do because I love theater. And he told me about one of the productions he was working on. I said to him, I'm in, count me in as an investor on that. And then that just escalated to becoming an above title co-producer, and then I got diversified or vested across 6 productions. So it just grew over the years.
That's amazing.
Yeah.
Great story.
Yeah.
Well, Marco, we are so excited to have you on the call today. We really are. We have been all giddy about it in our office because we love your podcast.
Well, thank you. I appreciate it.
Awesome. Well, if you guys are joining us for the first time today, or if you heard about us through Marco, we'd like to introduce you to 2 of our other speakers. It's been a minute since we've had all 3 of us on a call. With summer vacations, it seems to hit, you know, one of us was out, so it's nice to have the 3 of us back today. And I'm going to start with our Director of Lending, Jeff Johnson. Jeff started his career in lending and sales management in 2000. And he's going to be providing you insight today from his years of experience as well as his experience in Catalyst. If you've ever worked with us or done a deal, you know that Jeff strives for excellence and oversees all deals to make sure that our customers are happy. So definitely reach out to Jeff if you are interested in working with us, and he'll direct you to one of our fully licensed loan officers. Next, we have our recent that we're all here today, licensed real estate agent, active investor, and CEO and founder of Catalyst Funding, Wade Comeaux. Wade started his journey in lending and management in 1995, and he will be sharing with you both insights from his career as well as his experience and perspective from a lender and an active investor himself. So guys, we're so excited to have you.
Excellent.
Wade, I'm going to go ahead and pass the torch over to you for this next slide. This is just a little bit about us, so you guys have an understanding, again, if you're joining for the first time.
So we have a lot of content to cover, so I'll be brief and hit a few highlights. We're passionate about being a one-stop shop for real estate investors, and our secret sauce, in our opinion, is focusing on the buy and hold investor. So we provide both hard money and permanent financing loans, and a wide variety of permanent financing loans, from conventional loans and non-QM loans, to help you build that wealth that Marco talked about earlier and that we're going to cover a lot today. We also have specialized products for short-term rentals and a wide variety of VIP flip programs as well. So if you're a more affluent person with some experience and you want the best products and the most flexible arrangement, then we have excellent products for you as well. And I think I'm ready to dive into the presentation.
Yeah, I'll cover this one and we'll just kind of go from there. So so this is a chart we look at a lot. It's housing starts versus the population. And as you can see, this goes back to, say, 1990-ish. And you can see that the housing units went from 1,200, rose steadily up to 2,000, 2,100. And the financial crisis hit and they just plummeted all the way back down to 600. And they've slowly started to build back up. But if you look at that green line going across the middle, that population has been steadily growing over these years. So a lot of the reasons we see issues with the housing market and the demand and the prices are right here in this chart. There just haven't been building enough houses relative to the population growth. I don't know, Marco, if you have any thoughts on this, or if you take a look at it.
Yeah, I can comment. So you're correct in what you just said. There's been a lack of supply. In fact, if you go back the last 20 years, last 2 decades, the only time we've actually exceeded production of housing inventory based on actual demand was in 2006 and 2007 in that time frame. But then every builder was building and overbuilding. But ever since then, our household formations have exceeded the amount of new housing inventory that we've been putting on the market. The low in the last decade was around 2014, 2015, where we were really behind. We were somewhere around 400,000 units per year in a deficit, and we've slowly increased that over the middle of the last decade, and then it started to accelerate over the last few years. Now builders are pulling permits as fast as they can. They're buying as much land as they can. They're banking lots, and what we're leading up to, I'm going off on a bit of a tangent here. It's just more information than you asked me for. Okay. But what we're doing is we're heading in a direction where we're going to have potentially excess inventory in some markets. So a lot of builders are banking land, pulling permits, and preparing for future growth and development. They are essentially preparing themselves to create enough inventory to catch up for the deficit that we've created over the last 5+ years. Now, that's all well and fine. We're now at a point where we're at about equilibrium in terms of what they are putting on in terms of new housing units versus the actual demand in a lot of markets. But the problem is this: in many markets, there's going to be a situation where we have an oversupply, Austin being one of those markets. They are building far faster than the actual organic growth and household formation in these markets. So Houston is also one of them. Austin is probably at the top of the list as far as red flag markets. Some of the markets around Florida are also areas of small concern, where there's so much new construction and building going on that there might be a point where there's going to be an oversupply of new construction. And then the first people to sell are the people who have to sell, and those are typically not distressed homeowners, but they're actually builders. So they start reducing the prices of their homes, providing incentives, which is another form of price reduction. And when you start to lower prices and you have an excess supply, you start to see prices soften and then decline. So these are the markets where you're going to see price declines first and foremost, and that's the problem with overbuilding. But anyway, like I said, I was going off on a bit of a tangent. We are still trying to catch up with the pent-up demand for the lack of household formations needed, or households needed for the formations that are being created. But we'll see that normalize between 2025 and 2030. At least that's what the data is showing.
Yep, that's what we've seen as well. It's still quite a bit to catch up, but hopefully, to your point, we'll start to see a little normalization there. This next chart is actually one that you submitted, Marco. So we'll let you start on this chart, and then maybe Jeff and I can give some insights as well.
Yeah, I kind of threw this in. It was more just for interest, not to have a big discussion around, but we can certainly talk about it. It was just interesting to see that if you go as far back as 1976, how mortgage rates always were higher than the rate of inflation. And there's a reason for that. Is because people want a yield. If you're going to invest in bonds or any kind of asset, paper asset, you want to have a spread. You want arbitrage between, what the real rate of inflation is and the yield that you're getting from that investment. But the anomaly in this is what happened here since 2021, where inflation went crazy and the real rate inflation started to escalate dramatically, and it actually exceeded the mortgage rates. So if you actually look at mortgage rates here relative to inflation, you're always generating a profit. There's always a spread between mortgage rates and inflation. However, in the last 12 months or so, we've seen inflation skyrocket, and now it has exceeded, the mortgage rates out there. And that's one of the reasons why you saw mortgage rates go up, is because people are expecting to get a rate of return. However, the bond market is somewhat complex. I think they've priced in the fact that inflation will come back down. And the other comment I'm going to make on this is that, if it wasn't for the Federal Reserve stepping in and owning approximately 25% of all the mortgage securities, those mortgage rates would have been considerably higher. And so, they're affecting the market, or you could also say it another way, they're controlling the market in the sense that they are buying, or they were. I mean, I don't know if they're buying as many as they were before. Maybe Wade, you can comment on this. But the Fed was stepping in and buying a whole bunch of mortgage securities in order to help control that market and keep those mortgage rates in check.
Yeah, they are tightening their policies some from where they were, definitely. They are still a major player and a huge impact in the market overall. And if they were to totally take the foot off the gas on purchases, then to your point, there would be significant changes to interest rates at an even higher level. So they are operating under a tightening model, but with recession also being a very popular buzzword today, you have two competing challenges that the Fed is facing, right? You have inflation at a really high 40-year high, and then you also have a recession at the same time. And they have some real important decisions to make in the future. But they're already talking about, they have projected rate increases and Fed meetings throughout the rest of the year. But now they're talking about not being as predictable, and that they don't know what's going to happen until they get data. They're going to be more nimble throughout the rest of the year. So it's going to be interesting to see. A lot of bond investors are already projecting that the Fed is going to start to lower rates in early 2023. Now, we'll see if that actually happens. To your point, you see what the Fed did back in 1980, massive increases to rate, and it was the only way that they staved off inflation. We have not increased above inflation yet. So the question is it really going to be able to turn it around?
Yeah, I mean, I just actually looked up this was one of the slides I was going to send, but yeah, so the Fed owns $2.7 trillion worth of mortgages, which is actually a quarter, 25% of the entire market, mortgage market. But they've tapered off. They really went gangbusters in I think late 2020 and started buying up mortgage securities, and now it's now it's at a point where they're starting to taper off. But it's a lot. I mean, they can still control and manipulate the market. What they intend to do will be seen, over the course of the next 6 months.
For sure. One other important note we covered in a previous presentation, I'll just mention quickly. We can go to the next slide, but the debt to GDP ratio back in 1980, I think it was 34%. So 34% of the overall GDP was the size of our national debt. Today, that number is 124%. So another important thing is that if they increase rates that relatively, we have to pay that back, right? And to pay it back as 124% of GDP is a way different scenario than 34%. So that's another very telling thing that makes me think it's really impossible to increase it at the level that we did in the 80s because that totally different debt load that we cover at the moment.
Yeah, well, you're opening up, you're going down a rabbit hole and you're opening up a can of worms with that, because we could almost like start putting on tinfoil hats here and talking about things that, you know, that are maybe controversial or people will scratch their head. The thing is, you know, once you get past 77%, you know, the debt to GDP level, it's almost a point of no return. At that point, you're basically, it's QE to infinity. You're going to be constantly printing currency in order to, you know, pay the interest on the debt and keep the debt in check. So if you look at all the countries around the world, you know, their debt to GDP ratios are, especially first world countries, are over 100%. I mean, look at Japan. Japan is nearing 200%, and they've been that way for a very, very long time. And there's no turning back. They're just going to continue to print currency and, you know, debase the currency. But that's the only way out. It's the only politically correct and politically favorable way to deal with national debt. So it's not good when you have debt that high, especially over 100%. But it's been said that 77% is the point of no return. So this is the new normal. We are going to be in an inflationary environment, hopefully a controlled inflationary environment. It is QE to infinity, which means that the Federal Reserve will continue to put assets on their balance sheet in exchange for currency that they're providing the federal government and putting into the system to help juice it. But our system is not based on assets. Our economic system is based on debt. Everything is credit. Even the dollar bill you carry in your pocket literally says Federal Reserve note on the top. It's a debt instrument. It's not backed by gold, silver, or anything else for that matter. This is just the world we live in. So we will continue to print forever. Richard Duncan, an economist, an American citizen, but he lives overseas. I interviewed him, a two-part interview about a month and a half ago. Very, very, very interesting interview. He just released a new book about a month or two ago called The Money Revolution. And it's three parts. The first part of that book is the history of money decade by decade by decade, which is very interesting. The second part, he talks about what this new normal is and why we're printing you know, so much currency, and we have to, and every country has to. And this is just where we're at, which kind of segues into this slide, you know, to some degree that you have on the screen right now, the great inflation hedge. But anyway, like I said, you know, when you start talking about debt to GDP, you know, it's wishful thinking to think that we're going to pay it down and get it back under control. It's highly unlikely.
I agree. So the question is, what do we as investors and people who want to have a sound financial future do about it? And I think this slide that you presented, a second slide, really gives some good indicator. One thing I was amazed to see here is that there has not, despite the fact that there were times whenever home prices dropped, and there are some pundits who say that's going to happen in the future, although I think Marco and I both disagree with that. What has not happened is there has not been a time when single family rents went down on a national level. So that's very telling part of this slide. No matter what the massive drops that took place in the great financial crisis, the global financial crisis, you don't see that in rents.
Yeah, so here's my spin on it. If you look at what real estate is, especially residential real estate, and you know, my favorite, of course, because this is our business, is investment real estate. It's made up of commodities. You have two components. You have land, which, you know, you're not producing any more land. It's a fixed and finite resource. And so because supply is fixed and limited and demand continues to increase, it's a good investment. You know, over time, on average, the value or price of that land will go up. You look at the other component of real estate, which are made up of commodities: sticks, bricks, copper, and concrete. Those are inflation hedges. Those, again, over time will keep up with the real rate of inflation, if not exceed it. But it's supposed to, on average, over time, keep up with the rate of inflation. So that makes real estate an ideal and perfect inflation hedge. I mean, just think about it. It's commodities built, it's assembled commodities on a hunk of land. So from knowing that, and from that perspective, investment real estate can generate passive income for you, which it can and should. But at the same time, it becomes an inflation hedge, a perfect inflation hedge. What we see often, especially if you pick the right markets, which is something I'm big on, and something that we freely teach our clients, is which markets to be in. Then you can beat inflation. You not only can keep pace with inflation, but you can exceed the real rate of inflation. So we love real estate for that reason. When you look at, now keep in mind, the last 2 years have been an anomaly. If you look at the rate of inflation over the last 2 years, it's been approximately 20% per year on average, looking at it nationwide. That is definitely far from the norm. That's an anomaly. You can't bank on that. But that's because we've had, these factors going on, supply constraints, and COVID and other things going on. But if you average it out, you'll see that real estate has kept pace with inflation or exceeded it. Rents lag behind price increases in real estate, but they still keep pace. They lag behind, but they will still increase. And we're seeing more of that today because there is more demand for rental housing than there was in the past. So you, as a property owner, an investment real estate owner, are benefiting from that because you're seeing rents go up faster than they have historically, and this just adds to your cash flow and your yield on the property. So this chart is just showing you, how price appreciation and rents and the core CPI have, compared to each other year over year, even over courses of recessions. The bottom line is that real estate is a great investment. It's a great inflation hedge. It's something that you can build up over time, create wealth, and create passive income. And that's really, at the end of the day, what everybody should be doing, in my opinion. That's biased opinion, but that's what I think.
I think we definitely agree with that opinion.
Yeah.
I'm just curious. If you go back to that chart, you see the massive uptick in the pricing. Do you think rents are going to have a similar steep spike in the next couple of years? Because I didn't see any moves like the real estate prices on the rent prices.
Well, like I said, rents always lag behind price movements, and then they tend to normalize. A lot quicker. So they don't react as fast. In other words, they don't have the volatility or the alpha that you find in price changes. But yes, it will continue to rise because we have become a renter nation. I mean, home ownership was, averaged about 67, 68, 69%, during the housing boom of 2004, 2005, 2006, and then it dropped back down to 63%, which is more in line with historic norms. But home ownership is now staying that low. So that means that there are more people in the rental market, and as more people come out, the Gen Z, Gen X, as more of these people get into the market and move out of the home, they're going to be looking for places to rent. So demand for rentals is increasing through organic population growth, migration from other countries, and households being broken up where kids, becoming teens, becoming young adults, and they, move out into the market. And then you also have people like young adults who are actually out in the market now, living together, and then getting married and forming a new household formation, and they can't afford housing yet, or maybe they're not ready to buy, and so now they're in the rental pool, and so that's putting more demand pressure into the rental pool, whereas the supply is not growing as fast as that demand is increasing, and so that's putting upward pressure on pricing. So yes, we're going to see rents continue to go up.
Kind of leads into this next chart. So you look at the single family housing starts, which we kind of already discussed it. It's the same stats, maybe displayed a different way. But if you read the little bullet there, this came from the National Association of Realtors. Single family units fell to 982 in June, the lowest level since the pandemic of March 2020. But multifamilies were up to 577, which is one of the highest levels in 30 years. So I think people are probably seeing the trend that you're talking about, where folks can't buy houses at the clip that they want. So multifamily makes a lot of sense.
Actually, that chart you have there in the top left is exactly what I was talking about before. That red line is the number of housing units we need on an annual basis to keep up with organic growth. And you can see from 2009 through 2011, we were at the low point. So there was actually a deficit in terms of the number of housing units we needed to build relative to actual demand out there. And it slowly increased and got better as time went on. And now we're, like I said, at equilibrium, towards the end of this year. That's the forecast. And we're going to exceed it for the next several years. So we're going to make up between now and 2030 what we lacked since 2011.
Yeah. Another point there is if you're a single family investor, you shouldn't look at the fact that single family units are slowing down a bit as an indictment on your business model, because it's not. The reason that the multifamily builders are so aggressive right now is they realize that a lot of people that were previously buyers are going to be squeezed out of the market, and that means that they're going to be tenants, right? That's going to be a major factor. Or they're just going to hold off for a while in hopes that rates go down and they're going to sign leases at the moment. But there's a lot of factors. It's interesting on the slide before. If we could pop back for 1 second, I want to show one quick thing that's on this topic. If you look, whenever back in 2003, that's whenever underwriting guidelines really changed, and that blue line started to drop. That blue line is the single family rents, right? So there were fewer tenants and a significant uptick in buyers because, candidly, the guidelines changed. They took people who should have been renters, converted them to buyers, and then there were implications there. We have very clean underwriting standards across the mortgage industry today, but what's going to impact that now is just interest rates. As interest rates increase, there's either a recency bias from some people that can still buy and they just choose not to, or some people will be squeezed out.
Yeah.
This is also a slide you presented. Why don't you give us a few points on this, Marco?
Yeah, the slide on the right is just to illustrate something I was referring to as shadow demand. So, we've been talking about supply and demand and the imbalance there, and the challenges or problems that's been creating. It depends on what side of the fence you sit on. If you're trying to get into the market as as a new homeowner or as an investor, it can be a little challenging finding a good deal or the right price or even the right amount of inventory. But on the flip side of that, you've got as an investor, you're benefiting from what is going on. So if you look back as far as the 1900s, you could see the percent of young adults, which are people 18 to 29 years old. How many of those people were living at home with their parents? And it's ranged from 29% to a high now of 52%. So prior to this decade, the highest we've seen is in the 1940s, where 48% of young adults 18 to 29 were living at home with their parents. And then they went out into the market, started buying homes and renting. What we see right now is the highest it's been in the last 120 years. 52% of young adults are living at home and needing to get out, wanting to get out. Need to get out because they need to just get out and get away from their parents, or they want to get out because or they need to get out because they're getting married or they're moving or they're getting a job in another market, whatever the case is. But the point is it's a lot of people. And so, we call this shadow demand. They're living in one household with other people, but the moment they move out, they're creating additional demand or demand on the existing supply of rental stock out there, or even housing stock, which may or may not exist. And so this is good news if you're a real estate investor, because it's basically saying, look, there's a lot of people that are coming out, have been, will be coming out into the market that need a place to go, need a place to live. And so that's very bullish, if you're looking to invest in real estate or are investing in real estate. And this is also another reason why rents have been so strong. Rental increases have been so strong, especially the last 2 years. I have some units in Florida that we've increased rents about 15% in 1 year, and nobody blinked an eye. You know, they're still fully occupied.
Yeah. It's funny you say that there are a lot of young people that want to move out of their parents' house. I have a guess that there are some parents that want young people to move out of their houses as well. That's just a guess, but that's a great slide. Actually, that really is a nice segue into this next slide. Housing market squeeze pushes renters into bidding wars. And I thought this was an amazing statistic here. All-time high on apartment occupancy rate of 97.6%. That's a really shocking number. Tells you how few apartments are available. And then, so those people are either going to go to one of two things, right? New apartments, or they're going to go into single family rentals, or they're going to stay at home or live with other people. But it's just a really, really tight rental market out there. And as rates increase, which we do think is going to happen, at least for the foreseeable future, near future, that's going to put even more pressure on people looking to go to rentals instead of buying, and then really being able to charge premiums. And that you mentioned this earlier, that you were able to increase 15%, and it looks like asking rents for new leases were up 15% nationally. So that's a number not too far off some of the other averages out there.
Yeah, that's very coincidental that number is almost the same. Yeah, rent actually, people who are doing new leases are actually higher. Like if you're doing renewals are closer to 12%, in the 10 to 12% range for renewals, because they're already there. You know, if you're passing on a discount for renewing. But new leases, it's a new person. A lot of landlords, property management companies and whatnot are pushing it as far as they can, and that's where you see the higher number of 15%.
No doubt. All right, let's go to this next slide here. So this one, housing, it's some projections, right? Fannie Mae predicts home prices will be up 10.8% for the year. That's a big jump from its prediction just a few months ago of 7.6%. And then it was talking about how supply is still tight, and that about half as many new homes are being built as there were in 2007. And then the number of people, which Marco just covered, just reemphasizing that the number of people in prime home buying age is 18% higher than back in 2006, whenever there was not, eventually there came to a point where there was not enough demand for those homes, and home prices really dropped. And then Fannie Mae also predicts home prices will grow at a slower rate in 2023 of 5%, but they're not going to drop in the coming years. So they don't really, in the next few years, both Fannie and Freddie in several different articles have talked about the fact that they do not anticipate home price drops, just a deceleration of that outrageous appreciation we've seen over the last few years.
Yeah, that sounds about right. You know, builders are not going to stop building. You know, they're already deeply vested financially. They're continuing to buy land and pull permits. They may be slowing down. I forgot the name of the builder. Well, one builder, and I want to say it's DR Horton, but I'm not sure about that. They're actually shifting their strategy a little bit. They're more than doubling down. They're tripling down on the number of rental homes that they're going to be building, so that they don't want to cut back on volume. They still want to be selling the same volume, but they're making a shift towards rental housing as opposed to housing for homeowners. And the other builder, I can't remember the name. They want to keep the same volume going. They're going to be a little bit more careful in what they're building and where, and they may not be building as many spec homes. I'm not sure, but they want the volume. They still want to keep the volume going. So I don't think builders are slowing down. They're still going to keep up with building to meet pent-up demand, which is declining rapidly, actually, but future demand. So, and there was another point I wanted to make about this slide. So I think some of the markets like Austin, especially, which has a huge amount of new construction going on, I think those markets will see a slowdown in construction, because there might be a glut of inventory in places like Austin, Houston, the Idaho markets, which have been booming, incredibly booming. You know, even if you look at listings, not necessarily new construction, Austin has over 200%, has over a 200% increase year over year in the number of listings on the market. Boise, Idaho, 170% increase. Reno, Nevada, interestingly enough, 168% increase in listings. So, you know, we're seeing more listings on the market. So there is more inventory, and that's partly because mortgage rates have risen and, you know, sales have slowed down. But, you know, in time, that'll pick up again. Anyway, I'm not sure where I was going with that point, but
That's okay. I have a question. So you mentioned Houston and Austin twice now with regards to the amount of construction relative to demand. Is that just data that are you pulling specific data that's telling you that, hey, there's a lot of constructive relative to the population base?
yeah, it's just based on the number of permits that are being pulled in those markets.
Okay.
Yeah.
I will say I did, you know, Marco is from California, and I did see that both Houston and Dallas metro areas have more building permits. And this is as of a few months ago, we actually covered a slide on it, than the entire state of California, both of those major metros. So that does say that there is a tremendous amount of homes being built. That said, I do think there's a tremendous amount of population moving to the area. So it's interesting to see how that balances out. But there are an enormous amount of homes being built in those two areas.
Yeah, there is. But also those are, you know, those markets are also job magnets. There's a lot of people moving to, you know, Austin, Houston, Dallas, especially, Salt Lake City, trying to think of the other ones, Denver, Colorado to some degree. You know, these are markets that have a lot of jobs, and so they're drawing in a lot of people.
Sure. Yeah. Some competing forces there for sure. This is also this next slide. I think let's see, do we cover?
Yeah, we
can go over this. Okay. Let's go to the next slide.
We hit enough of it. Yeah.
Yeah. Okay. So I think we covered this slide as well. Pretty sure. Yep. Let's go to the next slide, please. There we go. So this is a slide that Marco presented. I think it's very interesting. Marco, you give your thoughts, and then Jeff and I may give a few thoughts as well.
Yeah, I just found this to be interesting as well. You know, you look at, if you look at, I mean, keep in mind, this is from 2020 to mid 2021. So, you know, 1 year, year over year, population growth estimates by the census. If you look at the states that have had some of the highest price increases, it's pretty well correlated to the amount of population growth in those states, especially Idaho, which, you know, has for many months been the fastest growing market in the United States. You know, with a 2.9% population increase between 2020 and 2021. But Salt Lake City and Utah, huge growth. The Texas markets, you know, very green. Florida, definitely. Georgia, definitely. South Carolina, even North Carolina. I mean, you look at these light and dark green areas, they've had strong population growth, and they've seen the highest price appreciation and rent growth of all markets around the country. You look at the red states like California, which for the first time in a very, very, very long time actually saw its first true net migration loss I think it was last year. You know, prices haven't come down. In some areas they have, but, you know, prices have maintained some degree of stability, with the exception of places like in LA and San Francisco. But it shows the correlation between population growth, which provides demand towards housing and rentals, and price and rent growth. So it's just, you know, if you want to look at trends, it's always good to look at trends in terms of population growth at the state level and at the metro level, because that will give you some insight, like a crystal ball, as to what the housing market might be doing over the next 12 to 24 or 36 months.
Absolutely. I think that covered that slide well. The next slide is a nice segue into, you know, the home price appreciation areas that he was talking about. Now, California still has had a 17% year-over-year number, but it's not as high as the 20% in Texas. Definitely not as high as like Idaho is. Am I looking at that right? Is that 29, 26%?
Yep, 29.
Wow, that's a huge number. And so a lot of these states, to your point, that showed that migration really had jumped up significantly. And there's home price appreciation everywhere. Like even if there was a net negative migration, home price appreciation was everywhere. It's just relative to the demand in those states. Jeff, I know you were kind of excited about this home buyer migration by metro size chart when we looked
Well, I
at
thought it was pretty interesting, where you see the massive drop in the 25 largest metros. You know, this only goes back to 2000, but you know, it's relatively stable. And then over the last couple of years, you know, I don't know if that has to do with remote work, or you know, the ability, just the metros getting too expensive, or just not too expensive so much, but relative to the rest of the country, it is expensive. And if you have the ability to move and still make the same money and live a much you know, cheaper real estate, presumably a better quality of life, not including the weather, of course, California, but I thought it was very shocking disruption over the last couple of years, because like I said, it's pretty stable for the last 20 years, and then all kinds of things are going crazy on the last few.
Yeah, one comment I'll make is, you know, with the 25 largest metros being, you know, the most expensive metros, affordability was low to begin with. And then when COVID came along and people had the ability to work remotely from home or literally, you know, somewhere else in the world, if they were a type of worker where they could work off of their computer, their laptop, their phone, and not have to go to the office, it gave people the opportunity to do something that they probably wanted to do or thinking about doing, and that is move to the suburbs or move further out where it's more affordable, or they get more home for the dollar, more square footage for the dollar, or maybe it's just less expensive and it was more affordable for them. So people did move away from the largest metros and buy elsewhere because they had the ability to work remotely. And so COVID was a catalyst when it came to working in less expensive or more affordable areas if you were a remote or mobile worker.
I do have a question, not a political question necessarily, but being in California, how much of the regulations on new builds do you think hinders the ability to add more housing in California and bring those prices down a little bit and make it more affordable?
A lot. There's a lot of regulation and red tape in California. In fact, I've heard that it can take up to 5 years before a builder or a developer can break ground and start building vertically, just because of all the red tape and you know, regulation and you know, the studies to look for, you know, fish, land animals, reptiles, whatever it is that you might be disrupting. I mean, you know, the level of craziness is insane. But yeah, it's a big problem, because you know, if you know there's a lot of demand today and you want to start construction in a year from now, it's not going to happen. You know, you have 4 or 5 years worth of regulation and approvals and permitting and everything else that has to go into that development.
Yeah. You know, I'm sure from a developer's perspective, it's very difficult it's difficult enough to predict what will be in a year. To predict what will be in 5 years is basically impossible. So it is a real leap of faith to make large scale investments into major developments. Yeah. It
is, you know, unless you're in a very tight market with limited land, like where I live here in Orange County, California, there's not a lot of place. There is land, but there's not a lot of buildable land, and any sections of land that are available for new developments take a long time to get through that process. So you're not taking a big risk knowing that there's pent up demand, because 5 years from now it's just going to be worse. So you know, developers are fine, but it just takes a long time to get going.
Understood. All right, let's go to this next slide. Marco had talked about this some earlier, the people in that age where they're definitely wanting to get out of home and buy a property. 18% more people in 2006. We discussed that earlier. And then the vacancy rate chart to the right is interesting. I'm interested in your opinion on this one, Marco. This is from Freddie Mac with the rental vacancy rate laid against the homeowner vacancy rate. Any thoughts there?
Well, whenever you have a vacancy rate that's as low as 2 or even 1%, that's virtually zero. That's just people moving in and out and moving around. That's almost negative, a negative vacancy rate. So that's very, very low. I mean, you look, it goes back as far as 1982. It's at historic lows. I don't know if that's what you're asking me, but
it's just to your point, like 97.6% occupancy rate in apartments. At the end of the day, the good news is for landlords, I think, and even people who are looking at flipping properties, while the flipping predictions are not as strong as they were maybe whenever rates were lower, as far as the landlord outlook, still incredibly strong. Rates aren't impacting that. It affects your cash flow a little bit, but you'll make a different offer price to make sure you still get your cash flow. I think where we're seeing, it's interesting where we're seeing some relief is that because everybody was just wanting to move into the space and rates were so low, investors could pay a premium, a very high premium, and still have a cash flowing asset. Now they can still pay a little bit less, but distressed sellers, there's never been a time that I recall where they were getting the prices that they were getting in the last couple of years. Whenever I first got into the space in 2012, I mean, we were taught to offer, 65 or 70% of after repairs value, less repairs. That number got up and sometimes to 90% on properties that could cash flow as rentals. So it's just those numbers will come down, but real estate investors will still be able to be profitable. And quite frankly, the distressed sellers are not going to be in a spot where they cannot afford to sell those properties because they still have a lot of equity.
There are not a lot of distressed sellers. I mean, it's at, I'm not going to say historic lows, but they are at extreme lows. There was a time when the properties we were selling, let's call it 10 years ago, were almost all newly refurbished properties. They were distressed situations of some kind. Let's call it a distressed property that's newly renovated, newly refurbished. It's now like new, what we call turnkey. And that was the bulk, pretty much almost 100% of what we were selling. Not that long ago, call it 7 years ago and more. Today that has shifted because there's so little distressed inventory, whether it's a distressed seller or a distressed property. There's so little of it that almost all, not all of it, but almost all what we sell today, in other words, what our investor clients are purchasing through us, is new construction. I mean, that is the product that we're moving right now, is new construction, because that is the only product available. So anybody who is a distressed seller, for whatever reason, they have options. There's enough equity in their property that they have the ability to sell it, maybe make a profit, probably make a profit, but be able to refinance or sell their property. They don't have to discount it and give it away because there's just so much equity in most of the properties around the country.
Absolutely.
I thought this little stat on the left-hand side was pretty interesting, talking about how much impact raising interest rates has on growth. They basically have a ratio of 1 to 5. So for every interest rate increase, it should slow down home price growth by 5 points. Was kind of their analysis.
4%.
Yeah. Well, it was 4. One of them had 4%. I think JP Morgan had 5, or 6. So if you split the difference, call it 5. So yeah, between 4 and 6% home growth reduction based on increased interest rates.
That's a very important point. So it's not, that doesn't mean like home price depreciation or anything like that. What it means is, I think we've been hovering around 18, 20%. So 1% increase in interest rate would take that from like 20 to 15, right? Another 1% would take it from 15 to 10 potentially, so on and so forth. That is a straight analysis of interest rates. That is not necessarily baking in a thorough analysis of demand impacts to that as well, right? Sure. So I think, but it is interesting. There's a decent statistical analysis over a long time frame. One of the things that I saw was a confusion in that number, is that one of the biggest times whenever it looked like there was a huge impact was in 2006. I remember reading that report, and there were other reasons outside of interest rates that obviously home prices drop then. Sometimes there's correlation and not causation.
Yeah, that's true. I think related to that is, the rising home prices, or excuse me, the rising interest rates from the beginning of the year have actually pushed down home buying by 21% so far this year. So there were about 6.5 million existing home sales at the beginning of the year, seasonally adjusted, and now we've dropped 21% to about 5.1 million. Existing home sales. So it does have a significant impact. A 21% drop in a half year because of rising rates has an impact on sales, and therefore that will have an impact on prices because when demand drops, as long as the supply is constant, sellers will probably end up adjusting their prices down in order to compete and get their home sold.
Yeah. It's funny. I was listening to someone on a financial radio station the other day talking about how home prices are unaffordable today, but that's often they are not as affordable as they've been in times past. But it's very interesting the size of homes. If you ever go into a neighborhood that was built in the 50s, and the homes were so much smaller, like they are more unaffordable, but they're 3x the size, 4x the size that we're building now. So you have to really bake that factor in as well. And the size of families were exponentially larger then. It's kind of amazing. You look at these homes built in the 50s, they're 3-bedroom, 1-bath. They, probably on average maybe had 5 kids. It's just an entirely different mindset.
I meant to ask you that, Marco, because do you think that the size of the new builds relative to, say, the heyday of the big mansions of the mid 2000s, you think they're going to go down significantly relative to what we've been seeing?
Are you talking about square footage, or are you talking about
square footage?
It's a very interesting question. I don't know. I think we've gone past the days of McMansions. That seemed to be in vogue and kind of a trend way back when. But I think there's a move right now to a lot of builders are building 4 bedrooms. Like there's this fixation on 4 bedrooms, 2.5 bath homes as being kind of the stock go-to model right now. It's very attractive even as a renter, just to have that extra room for an office or for storage or for a guest bedroom. But the days of 4,000 square foot plus homes being the norm, I think, are behind us. Now we're in the 2,000 to 3,000 square foot range. Again, this is very market specific. It really depends on where you go. I mean, you go to Naples, it's going to be a different story than going to, I don't know, some suburb in Houston or Austin, possibly. Yeah. But I don't see a demand for massive homes anymore. Unless you're in the top 1% of income earners or wealth holders, then yeah, it means nothing to you to spend $10-20 million on a house. Right. So
yeah, I think I agree with Marco. I think that's one of the ways that people will react to greater demand, home price increases, possibly higher interest rates for a period of time, will just be, the builders may build more reasonably sized homes. This next slide is very interesting. So this is from Freddie Mac. They are explaining why they predict home prices to continue to grow. And these are the 5 reasons why, and we can talk through them. I mean, we've talked a lot about mortgage interest rates. A very interesting one is supply, and that new construction remains limited by supply issues and other constraints, while loan modifications, forbearance, home price appreciation should prevent a large wave of distressed sales. We've talked about that particular topic in several previous conversations and also webinars, in that there was a lot learned from the financial crisis of 2006, and that whenever there was a forbearance, they required people to make all payments at one time. So you can't make a payment for 12 months. How in the hell are you going to make 12 payments in 1 month, right? It's not really feasible. And they learned a lot from that, and Fannie and Freddie have already announced that they're going to tack that onto the end. So that's a very positive development. But I think overall, we learned a lot from handling those situations. And candidly, there's a lot more equity at this point, and lots of ways that people can react to financial difficulties that could come about through the recession. We're seeing some layoffs, but there are a lot of different ways they can handle that. They're not upside down in their home. They can still sell and make a profit at this point. Jeff, do you want to cover a couple of these other ones, like first-time home buyers, anything like that?
Sure. I know we're kind of running up against it, so we have a couple slides left, so I'll try to go fast. But the migration to the south and the Mountain West, I thought that was interesting. Kind of talking about restriction to construction. If they do not restrict it, prices will stabilize eventually, but it's going to take years. And talking about larger homes, we were just talking about square footage. I do think, well, yeah, you're right. Like the McMansion age is probably over. The desire for more square footage, bigger like studies, because people are working from home so much, that did have an impact, in my opinion, on a lot of that stuff for sure. Next slide.
I think to Marco's point on that topic, though, you don't have to have 4,000 square feet
No.
to have 4 bedrooms and 2 baths. I mean, it was, you can totally do it with far less than that.
Yeah.
And one quick comment, a lot more people are staying put, and we saw this over the last 2 years with COVID, even 3 years. A lot more people are staying put and choosing to spend their money on home renovations and yard renovations than they are moving into a newer home or upgrading. And that's why places like Home Depot have just been super busy and booming. And contractors, you can't hire a contractor. They're all busy. They're turning down jobs. Because people are choosing to stay put and just upgrading, the homes that they live in now.
Definitely.
Destiny, I see your face. Does that mean we're on the clock, huh?
Well, Marco, we often talk about the Affordability Index, and a lot of our regular attendees have heard Jeff and I's opinions on it. Why don't you cover this chart, what you see from it, a couple takeaways?
Yeah, you probably talk about this a lot. I mean, this is just very interesting just to see how different markets stack up and compare to each other. There's a lot of markets that have become expensive and very expensive. Clearly, you can guess many of them: San Francisco, San Jose, Los Angeles, and to some degree, Orange County, to a large degree. But we like to focus on markets that are typically in the green down at the bottom, and to some degree the yellow markets, because the numbers pencil out. You can get a good cap rate, a favorable cash on cash return. These are markets that are still experiencing growth in population. They have strong and diverse job markets. So that's one of the reasons I like this slide is if you're thinking about real estate investing, or you are investing in real estate, consider these markets that are in the green and to some degree in the yellow. The U.S. national average there is 31%, which is not, uncommon in terms of affordability when you're looking at housing costs to income ratios. But if on the flip side, I will say, because it all ties together, if you are holding property that are in these red and orange markets and you're what I call equity rich and cash flow poor, there's a great investment strategy here. What you can do is you can take those properties, and if you either can tap into the equity to pull cash out tax-free, use that for down payment capital to buy additional properties and build your real estate portfolio, or you can sell those properties tax-free using a 1031 exchange and reposition and redeploy that equity into a newer, larger portfolio of properties in some of these other markets that produce better cash flow. So you're still keeping the equity, preserving it, protecting it by being geographically diversified, while increasing your cash flows and your cash on cash returns by having better cash flows from the properties in these other markets like Jacksonville, some of the Texas markets, Houston, Chicago, Nashville. These are markets that, we tend to focus on because the numbers work. So that's the takeaway on this slide.
Awesome, thank you. So I just want to pop in really quick. This is our last content slide. I know some of you guys have to hit right at 1 and drop off, but we do have a couple questions. We still need to give our half off hard money processing fee winner the award today. So if you guys don't mind hanging back just a little bit longer, I think we'll wrap up around 1:10. Thank you. And I'll go ahead and pass the torch back to you, Marco. I know these are your predictions for 2022.
Okay, thanks, Destiny. I'll run through these quickly just because we're running out of time. And Wade, Jeff, just feel free to jump in anytime. But I'll just kind of stay at a 40,000 foot level with this. probably everybody's guess, inflation will continue, and it's going to continue to push, costs, prices up higher. Although I think the Fed is probably going to get a handle on this and start to curb. All they want to see is a downward trend. They probably don't even care if the inflation rate drops by 0.1 or 0.2%. The fact is they just want to see the trend reverse, and that will bring some confidence to consumers and confidence to the market. And we saw that just literally yesterday, Wednesday, when the Fed announced that, a 3/4 point increase. Some people were afraid that it was going to be 1%. I think the Fed believes that they can, put inflation under control and start to drop it down over the next 6 to 12 months. But, along with that, people's incomes will continue to increase. We've seen the average income of tenants increase 10 to 15% over the last 1 to 2 years, which is in lockstep with the rental increases in many of the markets. So even though rents are becoming more expensive, some people shouldn't be complaining because their salary or income is increased almost at the same rate. And it'll drive more capital into the industry because people are looking for inflation hedges and places to park their capital. What did I write here? Investment strategies. Just continue buying rentals. It's a great inflation hedge. If you know in the right markets to invest in, you can build a portfolio that will preserve your wealth, grow your wealth, and create cash flow. And that's my formula that I use for myself personally, and that's what we use with clients. But that is the ideal investment strategy today: is some sort of asset class that generates income and is a hedge against inflation. Home ownership. What did I have here? Great inflation hedge with a fixed rate. Yeah, I mean, Wade could talk about this all day long, but it's nice to be able to lock into fixed rate mortgages to protect yourself from increasing rates. But then what if rates go down 1 or 2% over the next year or two? Well, you could always refinance. Just you have to rely on guys like Wade to make sure that you don't have prepayment penalties that are excessive and all that kind of stuff. So you kind of position yourself early with the expectation of rates going down sometime in the future, so you can refinance, increase your cash flow, lower your debt load and your interest rate. Construction will continue to be solid for the foreseeable future. We are still making up for years of deficit. We will catch up at some point, and that'll probably happen on or before 2030. But right now, what used to be the norm of 1.47 million housing units per year that we would need on average in this country has gone up to about 1.8 million housing units. So demand has been increasing for housing. The rest of the slide is pretty self-explanatory. We're going to see continued growth in price and rents for the remainder of the year. Now, interestingly enough, we've had such massive growth for the past 6 months of this year. We've already hit these targets for 2022, and we're only in July, August. What that means to me is that we're going to see a flattening out of price growth and rent growth for the rest of the year. It may continue to go. I mean, there's enough momentum there that we'll see continued growth in rents and prices, both in the resale and new home market. But we're getting near that point where we've probably topped out what is the forecast for this year. And optimism has dropped, but we'll continue to see optimism going forward, especially as we see headline inflation drop, and the media starts talking about that more and more.
I'm glad you mentioned the strategy on the previous page about pulling cash out of these equity-rich properties to buy more rentals. We have a little worksheet that we send to borrowers with that exact same math, because it's very powerful. Just the ability to pull cash out, buy real estate, and then hold on to it for any number of years. But the longer it is, the more ridiculous it is. A good decision, because it's just the wealth grows and grows and grows. It's just people.
Yeah, and you lower your risk.
Were 3 and 4% before, and now they're higher, and a lot of folks can't get past that. But if you just look at the math based on historical trends, it's a no-brainer to do that exact strategy you talked about.
Yeah, and it's a tax-free strategy, and if done right, you lower your risk. You lower your downside risk in losing that equity. So you help to protect it and preserve it, but you put it to work. You actually turn it into more cash flow. There's no downside to it. It's all upside. And there's a lot of people who live on the coastal markets like California, New York, New Jersey, Oregon, Seattle, that are what I half jokingly say you're equity rich and cash flow poor. It doesn't take much to change that, to turn around and improve your financial situation.
Yep.
That's arguably one of the biggest mistakes that people have made over this huge run up in home price appreciation the last 5 years, is not taking out equity and getting in the game at a higher level.
Right. True.
Okay, so sorry, go ahead, Destiny.
I think we all talked at the same time.
Yeah.
I was just jumping on to say it's been an amazing webinar, and we're so grateful for everyone that joined us today. I will start by announcing our half off your hard money processing fee with Catalyst Funding. Our winner today is Terry Lawson. Woo! Congratulations. You'll get a follow-up email with a certification from me. Oh, Jiminy Crickets. There we go. And now we are going to go ahead and jump into questions. My first question is for you, Marco. This was earlier in the webinar. This is, what was the book that you named? The Money Revolution. Who is it by?
Richard Duncan. He's an economist. He was chief economist for several large organizations. He was worked with the IMF and many other big institutions. So really, really nice guy, very smart guy. The Money Revolution, Richard Duncan.
Awesome. Thank you. Okay, guys, add that to your summer reading list. You've got a month. Our next question, I'm not sure who can answer this, probably anyone on this call, but I'm not sure who it's directed for. 5% owner occupied. Can you explain that? Is this overall markets? This might have been slide specific.
Oh, I think it was the interest rate that we didn't talk about it, but that was the going 30-year mortgage rate on owner occupied properties was what that was.
Oh, okay, you're right. You're right. Yep. And this next question, oh, that's actually the same question. What was the book? So we had 2 for that. And then we have, got here a little late, but should I continue to accrue money or invest right now? What do you think is best?
Marco?
Well, I know my answer to that question. So it's really two-part answer, but really one and the same. So you should have, some reserves in cash and an emergency fund. It's always good to have 6 months worth of cash in case of emergencies and if things come up. It's always okay to have, cash on the side, but keep this in mind, especially if you're sitting on a large pile of cash. With the rate of inflation right now, you are losing money. You're losing purchasing power, because just assume for a moment that inflation is at 12% per year, which is very arguably what it is, if not more. That means if you're sitting on $100,000 at the end of this year, you just lost $12,000 worth of purchasing power, because everything else that you buy, food, energy, clothing, et cetera, has gone up by 12%. So you can't buy as much at the end of the year as you could at the beginning of the year. So it's actually not smart. It's kind of dangerous to be sitting on a lot of cash in a highly inflationary environment. You do want to sit on a lot of cash in a deflationary environment, which we haven't had in a very, very long time. We probably won't ever have, especially for any prolonged period of time, because it would just destroy our economy. So hopefully it's not financial advice, but hopefully it's answering your question, or at least getting you to think about it, that if you don't put your cash to work, if you don't put your money to work, you're losing money, because you're losing the purchasing power. Not only are you losing the purchasing power of those dollars, that cash, but you're losing out on the opportunities, which is an opportunity cost of what it could be doing for you if you were invested in real estate or promissory notes, or something where you're generating yield.
And I would add to that people often want to have cash and try and time the bottom, but almost no one ever does that accurately, right? So I think Marco would probably tell you the same thing that I'm going to say, is that if you're actively in the market acquiring properties, you kind of dollar cost average your acquisitions, even if there happens to come a point where there's some drop or something like that, whether that be the stock market or whether that be real estate. You're not trying to put all your eggs in one basket and hoping to time the market while you're losing purchasing power, and simultaneously you're not getting the appreciation in the cash flow. It's really so many reasons to not just have money in cash, but especially in an inflationary environment.
Awesome. Thanks, guys. Well, we are coming up right at 1:10, so that's going to be our cutoff time today. Before we go, Marco, I want to say thank you so much for joining us. And would you mind sharing your podcast name and where our viewers can listen?
Yeah, it's on the screen there, but for those that don't see it, Norada, however you want to pronounce it, Norada Real Estate, Norada, realestate.com. That's our main website. We're rebuilding the site for our podcast, but the name of the podcast is Passive passive real estate investing, and the website is passiverealestateinvesting.com. Thank you.
Awesome. Thank you, guys. All right. Well, thank you everyone for joining us today. We'll see you next month.
Thanks, Marco.
Thanks,
Really
everybody.
appreciate it.
Thanks, Marco. Have a great
Thanks,
one.
guys. Thank you.